Income tax 2020. Income. Come in, relax with income tax 2020. Income. When we're thinking about income with regards to the income tax formula, we're at the top of the income tax formula, remembering that there's basically two sides or two halves of the income tax formula. The first half being a modified income statement, that being up top here. The second half being the tax calculation, and then the calculation of credits and payments to get finally down to the bottom line, which would be the refund or amount. So we're focusing in here on the top half. So now we're thinking about the top half. We're up here, which is basically the income statement side of the tax equation. And when we're thinking about the income statement side, we're thinking about an income statement typically having revenue minus expenses. And we're concentrating here on the revenue side of things. Now, for a typical business, revenue is usually fairly straightforward because we get our revenue typically from one thing. We specialize in one thing that we do. Oftentimes, the categorization is more confusing on the expense side of things, given the fact that we spend money on a bunch of different types of things and therefore have different categories of expenses in order to generate income. But for taxes, the income is going to be a really important line item because there could be a whole lot of different things that we have to question and say, well, should that be included in income or not? What if I get an inheritance or something? Or what if I found money? Is that income? Like, we have a lot of different type of situations, especially on the personal side of things, where we get something, right? And the question then would be, well, is that something that should be included in income or not? Now, remember, for taxes, we basically, if it's included in income, that's kind of like a bad thing, right? Because we would like things to not have to be included in income, because if the income goes up on the tax equation, that means taxable income will typically be going up, and that means we're going to be paying more taxes. So the question here up on the income side of things is going to be, of all the types of things that we're getting, we're receiving and whatnot, do we have to include them in income or not? And if we do not have to include them in income, we would like to not include them typically in income so that we would not have to be paying taxes on it. So that's going to be the major question. Is this thing taxable or not? Is it something that we need to be including in income that would then possibly be generating a tax? The other thing we'll talk more about in a future presentation or in future presentations are that there could be situations where the income has a different tax rate to it. So remember, the general tax rate for the individual taxes is going to be the progressive tax system. So once we get down here to the taxable income, we will typically be applying out the progressive tax system, and that will be based on, different rates that will be based on the income level and on the filing status, such as single, married filing joint, or head of household. But we could have some areas where the law basically says this particular thing we're going to tax differently for. So traditional things that that is the case for, or could be the case for, could be something like dividends. Sometimes they give a tax break for basically dividends, and we'll talk more about that in future presentations. But they might say we're going to tax dividends at a different rate. So that means once you come down here, now we've got dividends in income up top. They're going to be part of taxable income, but then when you calculate the actual tax, you kind of have to actually pull out the dividends and tax them at the special rate that they said they were going to tax them out if they're qualified dividends. And then the rest of it would have to be taxed in normally progressive rates. Traditionally, we might have capital gains, which could be a similar kind of situation that we might talk about in a future presentation. So we might have to include them once again in the line item of income. But then when we get down here to the taxable income, although it be included in taxable income, we might not apply the standard progressive rate because the tax code says we got to apply some other rate. Now note again, the tax software will kind of do that for us, but we need to understand that. So when we do tax planning and that kind of things, we can say this income is different than this income in that even though it increases the taxable income line item, it'll be taxed at a different rate, impacting, the tax that will be owed. So those are going to be the major questions. Should it be included in income or not? And then if included in income, what's going to be the tax rate on it? Default will be ordinary income rates, the progressive tax tables, and then exceptions to that could be exceptions to that. So then we have the Form 1040. So the income is going to be in the top part of the Form 1040. So all this stuff up above is going to be the informational stuff. So we talked about the filing status, obviously the contact information, whatnot, and then the dependents here. Now we're into the actual numbers of the tax return. We're going to start off with the income type of things up top. Now, you'll recall that when we thought about our equation, we said if I was going to build this kind of form from scratch, And like an Excel worksheet, I would have this thing reported on one line item, right? One line item here, and everything else feed into it, say on another worksheet. Say this worksheet feeds into the tax formula on line 1. Now, because of the way the tax forms kind of grew up, it used to be that you kind of fit everything on one page. So they basically put a lot of the income lines on the first page here. So you can see the breakout of the tax exempt interest, qualified dividends, IRA distributions, pension, Social Security benefits, and so on and so forth. So the taxable interest and whatnot, and of course the wages and salaries and tips and line 1, all on the first page of the 1040. Now, many people might not have some of these line items, and that's why it can be a little bit confusing, because if I have a very simple tax return and I just have, say, W-2 income, then it can be a little bit confusing to have all these other line items on the first page of the 1040, which is why they moved some of them, why you would think you'd kind of move some of them off the 1040 to another form that would only be attached if necessary. And some of those line items then would include what's on a Schedule 1. So the Schedule 1 has additional income and adjustments. The additional income includes things like the taxable refunds, alimony, business income, other gains, and so on and so forth. So we'll go into some of these components of income in future presentations, focusing most of our time on the major income items. Now let's go through the general rule in terms of the tax code for income. So what will be included in income? So the general definition, except as otherwise provided in the subtitle, gross income means all income from whatever source derived, including but not limited to the following items: gross income derived from business, gains derived from dealings in property, interest, rents, royalties, dividends, annuities, income from life insurance and endowment contracts, pensions, income from discharge of indebtedness, distributive share of partnership gross income, income in respect to a decedent, and income from the interest in an estate. So the key here, just look at the wording here, except as otherwise provided in the subtitle. Gross income means all income. So all income from whatever source derived, including but not limited to the following. And then they give some more common examples of income down below, but it's not limited to those examples below. So the way the code is basically written, they're saying, hey, anything that you're receiving is income unless it's stated otherwise to be. So you can't basically say, we can't say, hey, I got this thing, we've received something here, but it's not included in these categories and therefore it's not income. That's not how it's basically being written here. We have to make sure, we have to basically prove that it's in an exception to what would be the norm, which is basically everything is going to be income. So that's going to be kind of the general. Now, in practice, of course, most of the common income sources that we're going to be receiving, the IRS is trying to lock down those sources by having forms that will report those income. So if we're doing more basic type of returns, we'll typically have reporting of the income. We'll have 1099 forms, we'll have W-2 forms that will typically report the common types of income, including, of course, wages, including like interest and whatnot, and gains and losses on stocks and sales and those types of things. The most common types of income, the IRS will, again, kind of lock down. How do they lock that down? How do they get those forms to be set up? They're going to be pressuring the person who's paying the other person. And we'll talk more about this in future presentations. But notice there's two sides to any transaction. So the side that is paying is going to want to get a deduction for what's being paid. The side that's receiving is going to have to record income. So from a tax standpoint, the person receiving something doesn't have an incentive to record the income for taxes. They're not going to want to, right? I mean, legally they need to, but notice their incentive is to report as little income as possible. The person paying wants to have an expense, and therefore the IRS has leverage over the person paying to tell them through a 1099 form, a W-2 form, and so on, that they're giving something to somebody else, which most likely should be income. And those forms then are going to help the IRS to double check and audit and drive, and they'll also help us to record the normal income. So most of the income, hopefully, will be driven in that way. We'll have documentation of the income, but remember that the general rule is that it's income It's income whether you receive a document for it or not, and it's income unless there's an exception to it. Now, it's useful, you might want to know where this is in the code, and you can look this up at this link, or you can go to the IRS website. So if you just go to irs.gov and then type in like the tax code, you'll get to this site, and then you can go to the table of contents if you just want to kind of review the income portion of the tax code. So if I just go into the Internal Revenue Code here, and then I'm going to go into the income taxes, which is sections 1 through 1564, the normal income tax. I want to look at normal tax and surtax, tax on self-employed income. I'm going to go to chapter 1 here, and then determination of tax liability. Then I want to go to computation of taxable income, and that is on section 61 through 291. And then if we go into here, the definition of gross income is going to be here. So then I can go into here and get more detail. And now we're kind of going through the line items on our income tax equation. So if I take a look at the income tax equation, starts at the income up top. So we'll start at the income here, which is going to be, start at section 61. So we've got gross income, adjusted gross income, taxable income defined, and so on. So then you can go into gross income, section 61, and this is where that general rule is, exempt from otherwise, except as otherwise provided in this subtitle. Gross income means all income from whatever source derived, but not limited to the following. And then you've got this information here, cross-reference for items specifically included in income. You can see part 2, and that's section 71 and following. The items specifically excluded from gross income, you can see part 3, section 101 and following. So if I go back here to part 3, items specifically excluded from income might be of interest, and that's going to be that section 101. So they have certain death benefits, gift and inheritance, interest on state and local bonds, compensation for injuries and sickness, amounts received under accident, and so on and so forth. So if something's not included in income, typically, you'd need to kind of generally make it fall into one of these categories. Otherwise, the default would be income. But in any case, you can take a look at the actual code here, which could be useful practice to do.